And I am interested in this topic specifically because I run a small business. So it's always nice to get financial tips and tricks and insight into how I'm doing things and maybe some things that I should be looking at. So welcome everyone. And who would like to give us a chat first? And if you guys would show your video, I would love to see everyone's faces. You can turn them back off, but I just want to say hi. Somebody want to go first and tell us why you decided to join?
Yes, so my name is Chris. I am originally from France. I was based in Spain, so now I'm here in Tbilisi. I'm interested in the topic because I think it's important to keep updated with subject like finance, and especially, I mean, my interest is not to depend on brick and mortar businesses, but also be interested in other type of financing, crowdfunding, cryptocurrencies, bitcoins, etc. Just now, I'm not running a business, but I'm getting informed, and I discovered Lokal Tbilisi 10 days ago with a film talk. Thank you.
Thank you, Chris.
Ruth, would you like to introduce yourself?
I was just about to move the mouse to the unmute button. Yes. Good morning, guys, or good evening. So here it's 7 o'clock, so I will turn off my video in a little bit because I'm just not awake enough for a lot of screen time. I haven't had coffee yet, but no, I'm joined here for this topic at this hour because I work with a US tax accounting company that focuses on expats and on small businesses. And this is always a good opportunity to learn more about small business finances, what's interesting to people running small businesses, and maybe on the intersection between financing, structure, and taxation. It all goes hand in hand. So that's why I'm here. And always to see Candy's lovely face. Hey, girl.
It's really good to see you, Ruth. I've missed you.
Likewise.
I can't wait to have you back in Tbilisi.
I know, but it's going to take a little while.
I know.
So yeah, guys, I was here in Tbilisi last summer, and then over the holidays and into February. Good place.
All right. Samir, are you around? Do you want to introduce yourself? Let's see. I can.
I'll go if you want. Sorry, it's Russell.
Okay.
Yeah, sorry, my camera on my thing didn't actually work. I was trying to do it, but it'll just see it's just like a blank screen. Yeah, failed to start, so I can't even do it. But yeah, I've been here in Tbilisi a few months. I lived in Spain before as well. I was living in Spain for a few years. I've had some small business in the UK, mostly magazine publishing I've been involved with, and running the website for those magazines mainly. I've got a couple of projects maybe like going here, but like only at the start of them really, and I've just come here to come interested to see what's going on really.
Nice. Welcome.
And I know Samir as well. Like I don't know where he's gone. Oh, his camera does actually work. Like so, he's got no.
Yeah. I just managed to switch it on now. So.
All right. Nice. All right. Well, welcome, Samir.
Hi. So, are we introducing ourselves now? Or okay. Yeah. So I arrived in Tbilisi in February, probably the same time as Russell, I think. And then basically my goal here was just to check out the place, open a bank account here, figure out what the business environment is like here, maybe buy property here, investigate that actually. And then from there, obviously, when lockdowns and stuff took place, I started digging more deeper and started researching more about the business environment here and making more connections here. And this topic around finance in, I'm not sure if is it related only to Georgia or is it related like internationally as well?
It's definitely designed to be very international. All of the examples that I've prepared are based in US dollars, just because that was easier for me to do. Actually, no, I have one that's that was in Hungarian forints for a startup that I helped evaluate with a former colleague. But yeah, the principles apply in any any currency, any environment. It's not tax heavy, so we're not really looking at specific tax laws or situations that would only apply in a certain tax environment. So we're really looking at more of just how big businesses tend to think about their money and what where they want to put their working capital and how they can best get the most value out of their investments back into the business.
Okay, cool.
And so that's, and hopefully, even as a small business owner, you can take some of those principles and start thinking like a big business, even though you're probably not working with billions of dollars. You still have a limited resource. Every business has a certain amount of capital, and the challenge is, what do they best do with that capital to support the business growth? So that's kind of trying to take that big company CFO mindset and bring it to more small business owners, so that you can have, just like I said, some ideas what some of the bigger company CFOs would be thinking of in similar situations.
Okay.
All right. Well, before I kick it off here to Brett, if you have questions during the program, just type them in the chat box, and Brett will leave you to just make regular intermissions or whatever if you do have a break where you want to naturally like integrate questions into it. And then I'm assuming we'll have kind of an open Q&A discussion towards the end of this. And yeah, we'll take it. Ask everybody to mute yourselves. You can leave your cameras on or off, your choice. But just for sound reasons, if everyone's muted, we can hear the speakers better. So, all right, you ready, Brett? All right, it's all you.
All right. Well, yeah. So first off, I'll take my turn at the intro. Name is Brett Mueller. I come from the U.S., Minnesota, state kind of up in the north center of the country. And my background is a mix of corporate accounting and finance. I started with kind of a mid-sized company, about 60 million US dollars in revenue, and worked with companies as large as about 5 billion US dollars in revenue. And my last permanent position before I went into freelance was with a company called Jack Links, and they were a manufacturer and distributor of meat snack products. So if you've ever seen a bag of beef jerky, that is one of the products that we specialized in. So I will be using a lot of examples from that time, just because that was my most financially heavy role. And that's where I really got to integrate into the business and be part of the decision-making team, more than in any other role. So I will use quite a number of examples from that time. So I can quickly share screen and just give you an idea of what that product looks like, just in case you've got any questions. Yeah. Okay. Just so you can visualize it and have some idea when we get to those examples. But yeah, so that's kind of my my corporate background. I hold a CPA. That's just professional, certified public accountant. It's just something that accountants often get and financial people. So yeah, this is what the product looks like. It's just a bag of cooked, dried, and smoked meat. And that'll be a product that, again, I've used as an example for some of my scenarios here. So that was up until 2017. Since then, I've been doing a lot of travel. I was on the same remote year, well, not the same remote year program that Candy was, but I also completed a remote year program and went around the world and met a lot of folks like yourselves, entrepreneurs, small business owners, and I've just been doing freelance finance and accounting since then with a number of different clients and a whole bunch of different fields, logistics and distribution, e-commerce, software as a service, lots of different things. So yeah, that's more or less me in a nutshell. And I know you're here for content, not for personality. So I'll just leave it at that, and
I
we'll
don't
get
know. We
right
like
into the
personality
presentation.
too.
Oh, I'm sorry to disappoint you then. Yeah, this is not the topic for that. This is, yeah. Okay. So, small business finance, we already went through the intro. So yeah, I just wanted to go through a couple of different topics. Not wanting to get into anything that's overly technical or overly specific to any one country or one region. So I just wanted to get into some of the tools of building a budget, some of the different philosophies, what you might want to get out of your budgeting process. And then from there, that's kind of the big picture for a business. And then from there, kind of narrow the focus down into more specific decision-making processes, specifically about understanding working capital, how to get the most out of limited resources. And then at the end, there will be a bit of time left over to take more of the backward looking. So, building a budget that's forward looking. What do we think will happen? What do we want to happen over the next 12 months, 5 years, 10 years? Allocation of working capital, that's more what are we going to do tomorrow? How are we going to use the money that we have to make the best of the next week, month, year? But then there's always the question of, well, how did that work out? How did we do? Did we make good decisions? Did we make bad decisions? Did our plan come together? So we'll go through just a couple of simple accounting systems and one or two ideas on how you can set yourself up to answer those questions more quickly and easily, if that's something that you're interested in. So first off, why build a budget? If anybody wants to unmute and give an answer or two, why would you build a budget in the first place? Why not just, start doing stuff with your business instead of spending a bunch of time planning? Give everyone a second or two.
For me, I think this is like a no-brainer. If you don't have a budget, first of all, you don't know where your money's going, and you don't know how much you're spending or how much you should be spending. So allocating money into different areas, I think, is super, super important.
Mm-hmm. Yeah, absolutely. Yeah, definitely. I think that's what most people would think of, and that is the main reason that you want to build a budget. And as an extension to, yeah, go ahead.
The main reason of a business is to make money. So you definitely have to have a good look at your incomings and your outgoings, and a budget helps to allocate expenses to things that further your business, having a marketing budget, having maybe an HR contractor budget, those type of things. So you're pretty clear on what levers are there that are driving the income.
Mm-hmm. Yeah, another great answer. Another great answer. Yeah, and what we're really driving at here is is we're just trying to kind of slice things up into manageable decisions. A business, even a small business, is a pretty big project. We like to use the term the 800-pound elephant. How do you tackle it? You have to tackle it one bit at a time. How do you eat the elephant? One bite at a time was a famous thing that we like to say at my last company. And yeah, it's you get to put a plan together. You get to kind of chunk up your business into smaller units, and then you can have an idea of the overall picture and make sure that those pieces, they all kind of come together. So we'll see a few quick examples of that. I'm sure this is going to be more common sense and not so much super technical, financy discussion, but we'll go over a little bit of that in a bit as I've got some examples. But yeah, it's about trying to take the big goal and make it into smaller action items so that you can keep those pieces on track. And by doing that, you can understand, are you on track for your overall goal? Is the business on path, as Ruth said, to make money? So yeah, sounds like there's a lot of folks that understand the value. What about some different ways to do it? The nice thing about building a budget or any management accounting is there's no really right answer. There's no rules. Most countries have some sort of accounting rules that you do have to follow, but there aren't any rules in how you have to build your budget. You get to do it however you want. So what are some of the common ways to go about it? Well, two main theories. Again, there's literally an infinite number of ways to build a budget. But two of the biggest approaches are the bottoms up versus the top down. So just to kind of give a little idea which one might work for you. A top-down budget is going to be more goal-oriented. If your goal is to start up a small business, and one of the things that's very important to you is I want to replace my previous income that I used to have from a 9-to-5 job, then you probably are going to be thinking more at top-down. You have whatever you were making in the past, however many pesos, or what's the currency in Georgia? I don't even know.
Lari.
Lari. Okay. Yeah. Pesos or euros or lari or whatever it is. Yeah, you want to replace that income, then you're going to want to start there, and you're going to want to build up pieces that make sure that you can get there. I need to bring in X number of clients. I need to develop Y number of products that sell Z number of units each. Or maybe your goals are just bigger than that, and you just say, I want to have $1 million business. I want to have $1 billion business someday. That's more of a top-down goal, and you're trying to fill in the pieces beneath that. Again, it's good for big picture entrepreneurs. It's really good for folks that have a team. If anyone's in that category, that they can just kind of say, this is what I want, and you're the sales director. What channels can we go after to get to that sales number? Marketing, what kind of campaigns do we need? Operations, what equipment do we need to make all this product? So the only problem is, there's a lot of gaps. There's a lot of surprises. The reason that you have this team is you're not thinking of these things. And so, yeah, often, there needs to be a lot of communication between the different pieces. You need to do a lot of connecting the dots, even if you're doing this on your own and you're judge, jury, and executioner. And there are everybody has strengths and weaknesses. Everybody has areas where they're very knowledgeable and areas where they're maybe not as knowledgeable. Top-down budgets tend to leave those gaps and surprises and leave some of those areas maybe not as well explored as they should be. Compare that to more of the bottoms-up budget. This is more of the approach that you're taking if you have just a side business, or it's something that you're just kind of, you have it, you're not really sure what it should be. You're just kind of playing around with it. Maybe it can be a $1 billion business someday. Maybe it can replace your income someday. For now, you're just kind of having fun, making a little bit of money, hopefully. But you're just making things work from the ground up. This is more of the approach like, oh, I've got 10 people that have already contacted me that need my services. I've got 10 people that are interested in my software. I could maybe charge them money. I could maybe build a business out of this. I could get what I have now and build on it, and see how much it's worth, see how much money I can make out of it, if any. So this is good for folks that are more action oriented, that really like to work in the details, that like things to be a little bit more concrete than some pie in the sky number that you then have to figure out how to go get it. And it's much easier to involve your fellow business partners. One of the best things about it that I've found in my experience is that when you're working with these business partners and you're collecting data from them to help build this bottoms-up budget, it creates much stronger buy-in. Those folks, then they've contributed to the goal, they've contributed to the overall planning process. And whether that's an employee or whether that's a distributor or whether that is a digital marketing consultant, or whoever you're partnering with in this business, those folks then tend to be much more invested and they want to succeed. They want to deliver that goal. They want to meet what they said they were going to meet. So that significantly increases the buy-in versus, sometimes on the top-down side, it's like, I want $1 million in sales. Like, okay, thanks. I guess I'll see if I can do that. It's just a little bit tougher to get the motivation and the energy when you're giving those orders versus asking for input and asking for the partners to come back and say what can they offer, what can they commit to. The downside is, of course, that you need to know a lot more. You need to know a lot more about the business, about what's going to happen. You need to know a lot more about your customer base or your client base. You need to know what your product is going to cost. You need to predict what the commodity cost is going to do. You need to have some idea of how much you're going to have to pay for consulting, for labor, for software development, whatever it is that your business happens to deal with. And so that's the thing about knowns, and why I put them in quotation marks, is knowns are never really knowns. You can have a pretty high degree of confidence that a pound of lean beef is going to sell for $2.87 over the course of the next year. Maybe it works out. Maybe it's 2014 and it goes to $4. And your main operating costs just jumped by 30+%. That happened to us. That was a big deal for us back in 2014. I'm sure with a lot of things, with a lot of volatility in the markets today, I'm sure there are businesses that are having kind of some of those oh crap moments as well. So yeah, those are some of the advantages, disadvantages of the top-down versus bottoms-up budget. I would I just recommend you to take a look at yourself, say, what am I better at? Am I better at, am I better at conceptualizing big picture? Am I better at, setting a large goal and then just kind of figuring things out from there? Or do I operate better when, I have an idea what my next step is going to be, and then from there I can figure out the next step after that. And I want to see that next stone before I take that next step. I want to see the next 3 or 4 stones. I want to have that path across the river before I start. The first type of person's probably going to be thinking in terms of top down, and they'll just kind of make it work. Second type of person is definitely going to be looking more towards the bottoms up budget, building up from there.
I have a question.
Yeah.
Sorry, I'm just gonna pop in and interrupt. So I feel like I do a little bit of both. Is there like a combo of those two kind of aspects? I don't.
Of course.
I'm not a great budgeter. It's just not
Yeah.
something I've ever been good at. But I feel like in the beginning and in the pre-planning stage, planning for the business and that sort of thing, I was much more big picture. Because there were a lot of things that I didn't know. I didn't know how much the property was going to cost. I didn't know how much, chairs and furniture and all of those things, coffee and consumption. I didn't have all of those details. So I feel like I kind of started with this top down, but now I feel like I'm more developing as I'm finding out more and more of those knowns. I feel like I'm more developing a bottoms up budget. So is that?
Yeah, I mean, no one is ever 100% top down or 100% bottoms up. I mean, the CEO of the biggest companies in the world, I mean, I'm sure Jeff Bezos has some idea of what his developers are getting paid per hour. I'm sure he has some idea of the number of transactions and the number of different, different new users he's adding to Seller Central every month. And he has some idea of what regions they're going to attack. I guarantee you he has some plans there. And the most bottoms up person in the world, I'm pretty far on the right hand side of the spectrum, using this left and this right. I'm pretty far over here myself. Most people in accounting and finance do tend to gravitate towards this end of the spectrum. Otherwise, we probably wouldn't go into accounting and finance. But yeah, I mean, I can't tell you the number of times I've been deep in the weeds and like, okay, this is the cost of aluminum and the bending and breaking and blah, 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 and put it together in the box and everything. And okay, so this is a $7 product. Like, well, we wanted to sell it for $5. Like, oh, okay, let me think. So yeah, there's a lot of that kind of duality in play, and yeah, so you definitely need elements of both. It's just it really helps if you as a manager and as a business owner know which side tends to be your strength and which side tends to be maybe not your strength. So that you can start where you want to start in areas of strength, and then fill in and maybe get some help with the areas that you're not so strong. Also, it can help you set realistic goals for the business. If you know that you're good in this area, if you know that you are that kind of person that likes to have that next step, that likes to see a plan of action, then you probably don't want to put yourself in a situation where you're needing to replace income. You probably want to start that business as more of a side gig, build it up, take small steps, work in knowns, quote unquote knowns, and yeah, build it up little by little. That's just going to suit your personality as a business owner and as a manager much better than if you just take a leap and say, I'm gonna try and make this into $1 million business that can replace $100,000 a year of income or something like that. Something happening. Something happening. Oh, you can't see that.
So we've got a
Zoom was-
question. We got another
Yes.
question. How Chris is asking, how relevant is it to plan a budget in the context of inflation?
Yeah. Inflation is always one of those unknowns. You can predict it, but a prediction is, of course, just a prediction. It's still very relevant. I can pop this open. I already have it open. So I haven't ever actually done this. I've tended to be fortunate enough to operate in fairly low inflation environments my whole career. But if that's not you and you do have some concerns about inflation or a prediction about inflation, what you want to do is you just want to kind of build in an inflation estimate in the P&L, because inflation is like it's like a hurdle. It's like, if you start with a million pesos or something, and you want to operate for a year and you expect there to be 10% inflation, then just to break even, you want to have 1.1 million pesos at the end of that year, right? So you can kind of treat it like an expense item on the P&L, because it's similar to loan interest. If you are financing some of the small business, it's very similar to that. It's just, you better be able to make enough to cover inflation, and you definitely should include that as an item that you want to clear in that regard. So in this case, inflation, I would treat it like, this one's kind of tricky because inflation doesn't really go with the concept of financing. Like if you've taken out a loan and you're using somebody else's money, then you don't really care, because you're going to pay back that loan at the agreed upon rate, and inflation won't affect that rate. If you're using your own money, then you definitely would want to consider, your own investment. So in this example, what did I have here?
Chris, did that answer your question? Feel free to unmute yourself.
Yeah, I know that's kind of a curveball, so I'm kind of rambling a little bit, but all right, $200,000 I had as the initial investment into this sample business that I put together here. And
I feel like inflation is one of those things that there's always contingencies for the unexpected. For me, it was a global pandemic. Chris said something about Venezuela and 900% inflation. I mean, I think that there's definitely out of the ordinary things that are going to affect our budgeting and financial planning that we could never really anticipate. So
yeah, I think I want to add to that one. It's very similar. Is foreign exchange rate. If you make money in one currency but your expenses are in another one, like the last couple of months definitely probably took you for a curveball. For example, what used to be $200 in the peso amount, now it's only $150 in the same peso amount. So building in some buffer into your budget for potential foreign exchange rate changes if you have costs and expenses in different currencies, I think is a smart way to do. even though the amount, the extent is very hard to predict.
Yeah, good point.
Yeah, yeah, and that's a very good point, and I think that's something I do have a fair amount of experience with. We'll touch on that a little later, but it's really the same thing. You know, the only difference is that foreign exchange is looking at two currencies and how they move related to each other, whereas inflation is more one currency related to a standard basket of goods, or something that whose value does not change. So that's all. It's foreign exchange and inflation in my mind are almost the same thing. Yeah, it's just one has two variables and one has only one currency that can affect you. So at least in the US, I personally find it a bit strange that that US accounting principles require companies to report foreign exchange on their income statement, but they don't report inflation on their income statement. And I'm like, why not? I consider them to be almost the same concept, so I'm just a bit puzzled by that decision. But we're not here to talk about accounting principles or particularly US accounting principles, so I won't beat that horse to death. Is something more happening? I see chat. Okay. Okay. Yeah. Yeah, so that's kind of what we're trying to talk about here. Is that, yeah, it's something that you do have to account for. Yeah, I'm gonna get rid of this inflation thing because that wasn't coming together quickly. But when performing a plan like this, I can't remember where I stuck that. Sales plan? No. But there's an assumption built in here for the assumed foreign exchange rate. So any models that I build that deal with more than one currency, I always build in an assumed FX rate. Even in models that I build that only deal with one currency, if they go out at a significant period of time, like more than 2 or 3 years, I'll build in a certain amount for inflation. Usually it's like 2.5% or so. In the current environment, it might get a little bit more than that in the US. But historically it's been fairly low. Still significant on a 5 or 10-year timetable. But here, yeah, this is a big part of this particular business plan because this was a audiovisual distributor based in Budapest, and they were dealing with a lot of expenses that were going to be paid in forint. Most of the revenues would be coming through in either euro or US dollar. So it was very important to keep an eye on that exchange rate and do some sensitivity analysis, which again we'll cover in just a little bit. So any other questions? Did we somehow, some way cover that topic?
I think we're good.
Okay. Yeah, thanks for chiming in. Yeah, anything that's really top of your guys' mind, by all means, we'll wrap it back and forth. I may not have a prepared answer or be an expert in the topic, but I'll give it my best. All right. So then there's also an accounting system out there called the Profit First accounting system. It's become quite popular in recent years, maybe the last 5 to 10 years. it's a bit of a misnomer because it's not an accounting system at all. What it is it's a cash management system. It's not even really a budgeting system. It's just a cash management system. When you already have a budget, or at least the guts of a budget in place, I'll just explain what it is. It's a system where you take all of your incoming cash. Say you have, you know, $10,000 of cash coming in per month. You would take it and put 1,000 into one bank account, 3,000 into another bank account, 500 into another one, and so on and so forth. And then those bank accounts would be your budgets for different types of expenses. One might be for contractor payments. One might be for rent for your building. One might be to pay yourself a salary. One might be your savings for taxes at the end of the year. And so it's just a way that kind of, if you're not so good at, you know, if you're not so disciplined and you know yourself and you know that if there's money in the account, you'll spend it, even if you know you need to save it for something else, you can split that money up into 5, 6, 10 accounts and just kind of force yourself to keep that account separate, not move that money around. You know, it'll just force yourself to only use the contractor money for contractor expenses. How does that help? Well, psychologically, the idea is that you're going to be a lot smarter with your money when there's less of it. If you have $10,000 in the account, you're going to probably, you know, make it rain. You're not going to be too worried about spending $200 for a contractor here, another $400 for a contractor there. You're just going to let the money flow a little bit more freely. Versus if you're sitting there looking at an account that's only got $2,000 in it, you're gonna squeeze every dollar a little bit tighter. You're going to, you know, negotiate with those contractors a little bit more. You're going to kind of be more aware of the fact that, oh no, I've got 2 weeks left in the month and I need to make $500 last this 2 weeks. You know, I better really be careful about who I'm hiring for the next couple of weeks. It's a great mindset to have all the time, but the profit first accounting system is a way to just really break that mindset down and build it into day-to-day decision making, minute by minute decision making sometimes, rather than, you know, have that mindset be in place only at the end of the month or only, you know, when the cash is really getting low and you're really trying to squeeze everything you can out of those last few dollars or you know, euros or whatever. So yeah, I just wanted to touch on that in case that's something that you've heard of or have thought about. It can be a very valuable management tool. It's not really a budgeting system or an accounting system at all. All right, so back to the question of why build a budget. Again, you've all kind of grasped the concept. It helps you break things down. It helps you make decisions. It helps you realize whether or not the idea is viable. Can it really deliver on the goals you have for it? You know, do you think you're doing the right things? Do you think it's realistic to meet those goals with the actions that you're taking, or do you need to maybe go bigger, get some help? You know, bring in a professional to supercharge things. But one of the other most valuable ways that you can use a budget, if you've built it with the right mindset, is the concept of these budget levers. As everybody has mentioned, or as many of you have mentioned, and I'm sure all of you have experienced, no budget ever goes exactly according to plan. If it did, you would not need, you wouldn't be here because you would think finance was super easy and you would just be doing it on your own and you wouldn't feel like it was anything you needed to learn. So the concept of levers, though, is the business's way to, it's kind of like, you know, it's kind of like filling your quiver full of arrows. You know, you want to have a nice quiver full of arrows so that when something comes up, something unexpected comes out of the woods, you can pull out an arrow, fire it off, and get back on budget. An unexpected expense comes, a big client is lost. What can you do? So, there's usually not, I'll get to I think I have an actual slide on this. Yeah. So, usually it would be great if, you lost a big client, if you could just go out and get another big client. That would be great. That's a perfect lever. Replace the loss with a gain. Doesn't usually work out that way. So usually businesses have to have some kind of contingency plans. What can we do when that happens? What can we do when the exchange rate turns against us? What can we do when there's a big lost client? What can we do if there are some laws passed that make, say, healthcare 3 times as expensive for businesses to provide, like they did in the US about 10 years ago? So a lot of the most common things like if you've got people in your budget, how can we push them off? Can we, hire them next year instead of this year? Can we look at alternate supply chains? This was a really big one for Jack Links, the company that I worked with, because we had suppliers in Australia, in New Zealand, in Brazil, and in the US, and no one supplier could meet all of our needs, but any supplier could meet about half of our needs. So it was entirely possible for us to pick and choose, this year we're going to be heavy in New Zealand and Australia. Next year we're going to be heavy in Brazil. Year after that, we're going to be more heavy in North America, the US, Canada, and Mexico. Depending on things like the exchange rate or what meat costs did in different parts of the globe. So that was an extremely important lever for us to be able to pull if things like the US meat costs went through the roof, or the exchange rate with the Brazilian real was completely off plan, or shipping costs over the ocean became twice as expensive as planned. Having those alternate supply chains and those relationships in place meant that we had levers that we could pull to counteract those global pressures. And yeah, it's not realistic for a small business to go to South America and build a bunch of plants just in case there's an exchange rate difference, but it is realistic to have multiple different supply chains in place, to have relationships with different potential suppliers all over the globe. It's entirely possible to know a few contractors that could maybe perform remote work in a few different parts of the world that you could then kind of take advantage of if the exchange rate is going one way or another. I believe somebody mentioned that a lot of their expenses were in USD, so they're relatively insulated from exchange rates. What if you had alternate supply chains so that you could meet those same needs with folks that are in Georgia or in nearby in Europe, or like in Hungary with the forint, or Bulgaria or something, and you could move some of those costs to countries where there are favorable exchange rates if the opportunity allows. That would be one example of a way that even a small business can benefit from alternate supply chains and create some of those levers that you can pull in case of inflation being unfavorable or exchange rates being unfavorable. Advertising and marketing spend is another big one. That's, those are things that often they're nice to have. They're often not business critical, or there's a level that's business critical, and then beyond that is kind of fueling growth. So that can often be ratcheted down. Any capital intensive projects, equipment repairs or replacements, upgrades, remodeling, things like that, those can often be pushed back. One of the nicest ones to have, if you can, is a line of credit. That's a bit dangerous because it doesn't actually bring the P&L back online, but it does create the cash that allows the business to survive while you formulate a more long-term solution. So yeah, having those kind of those arsenals, having those arrows in your quiver that you can bring out and fire off when unexpected things happen that go against you. That's critical to many small businesses and really businesses of all sizes, just to make sure that yeah, you can survive, you can keep the business healthy, you can keep it going strong. And yeah, something like taking an on-site live-in workspace and moving it into a digital environment and creating contacts and just creating a community that's digital. In case of a global pandemic, that's maybe that wasn't part of your plan, Candy, but it's an example. It's an example of a lever that you can pull to not completely offset the damage, but still keep things moving forward.
So just a couple of questions. At the bottom of the slide, it says that the levers will match the key areas of risk. Is there a way to kind of look at your business and understand what your key areas of risk are? I mean, obviously, global pandemic was not one that I ever anticipated would be a key area of risk.
Yeah.
But is there like guidelines or something that somebody new in business might want to look at as a way of determining what those risk areas are?
Mm-hmm. Yeah. So,
or if I've got you completely off topic, tell me and we can stop. I'm just really curious.
That's kind of where sensitivity analysis comes in. I was planning to kind of round my way into that as the discussion goes on, but we can touch on it here.
Maybe I can chime in on that one a little bit as well, because we recently just went through that exercise and actually do on a somewhat regular basis. I think the key is, what are the key drivers of your business? In your case, it's travelers coming to, or nomads coming to Georgia. And then what are the key risks to that main lever? Pandemic, it's pretty hard to predict. Other risks that would affect traveling might be a little bit easier to predict. They might not have quite that big impact as the pandemic has, but you can kind of see where I'm coming from.
Like weather and seasons and hurricane season, or
or social unrest in neighboring country, the Russians coming over the border, whatever might be your risk to travel is a risk to your business. For us, any kind of legislative changes to taxation is a potential risk to our business, or an opportunity. You never know; those two go hand in hand. Really look at what does your business need to be successful that's not within your control.
Yeah. So one good thing to do is what's called a SWOT analysis, at least in English. It's looking at your strengths, weaknesses, opportunities, and threats. So strengths are anything internal. Your strength is you've got great attitude, great workmanship. You've got a lot of contacts. You've got relationships within Tbilisi. You've got a space. You've got all these things. Those are internal. Those are things that you control, you've developed, they're part of you. Weaknesses are things that you wish were part of you that are not at the moment, but could be. And then the opportunities and threats are the positives and negatives that are completely outside your control. Exchange rates, no one business can control exchange rates. Meat prices for jack links, weather, political conflict, pandemic, airplane crashes, just random things that, maybe not so random, but they might be predictable to some degree, but you just cannot control them. As you go into this business, you've go in fully knowing that, okay, these are the things that I just have to hope go well, or, you know, the things that I have to prepare a plan of action in case they don't go well. Sometimes that can be insurance, you know, obviously, like where I come from, there's a lot of violent weather, tornadoes can destroy a building, and that's just anyone that does business in Minnesota, Iowa, Missouri, Kansas, Texas, Oklahoma, you just have to risk it if you have a business that actually has a building. And then insurance, you insure against it. It's going to cost a little bit more than insurance in an area where there are no tornadoes. But you have to either accept the risk or you have to insure against the risk. But that's more, you know, that's more pre-planning, and that's more, yeah, a way that you can mitigate some of those risks and insulate yourself against some of them. Yeah, things like the exchange rate are ones where, you know you've got the risk. You could completely insulate yourself from risk for a time with financial instruments like you could potentially buy exchange rate swap contracts, which basically mean, if I've got $1 million in USD and I know I need to exchange that for euros at some point in the next year because I've got to buy a lot of things from Europe, I can just go ahead and forward contract, pay a premium to a bank to say, hey, I'm going to need 800,000 euros at the end of the year. Can I give you my $1 million now? And you give me that 800,000 euros at the end of the year, and then you don't have to worry about the exchange rate for the rest of the year. That's pretty advanced. I mean, that's usually a big business kind of a thing, not so much a small business thing. So I wouldn't recommend formalizing those insurance policies in that way, at least not with regards to foreign exchange rates. But yeah, sometimes there are things that you can do to just completely and financially insulate yourself from those risks. More actionable would be things like you go out and you get the annual membership. You offer a discount for somebody that signs up for a full year of co-working space. That helps mitigate your risk. Now you've got a client that is going to be able to use the service for a whole year. If something like a pandemic happens and you have to close, well, then you probably need to give them some of their money back as a good business owner. But you can also work with them in that situation and say, hey, I'll give you 3 months free for every 2 months that we're closed, or something like that. At the end, I'll extend it by 3 months for every 2 months that we're closed. Or generally speaking, once you've got the contract signed, it's a lot easier to keep the contract than it is to try and get somebody to actively extend. Or I'm sure as a business owner, you know this better than I do. But yeah, those are the kinds of things that you can do to try and set yourself up and be more prepared and just more equipped to weather unfortunate situations than you might otherwise be. It's a bit of locking the barn door after the horses run away in the current situation. But again, that's a lot of what finance is anticipating issues and taking steps to reduce the wildness of the variation. So hopefully that's a little bit helpful. One of the most common things that businesses of all sizes have to do. So one big risk for almost every business out there is collecting receivables. If you offer any kind of credit, even if it's just 7-day terms, like I myself, for my own business, I do work and then I send an invoice, and I just kind of have to hope that the client pays me, you know. So that's one thing that that's common to almost all businesses, and if it's a big area of concern for you and it's mission critical to your business, you can offer discounts for prepayments. You can offer terms discounts. Say, it'll be $500 if you pay tomorrow, or $550 if you pay next month. Those are difficult discussions to have. Most business owners don't want to have those discussions. I don't like having those discussions myself. But something like that is a way that you can reduce that risk and get the money in faster, because once you've got it, you've got it. It's yours.
I would say that's matter how you frame it as well. You can say, well, if you pay later, it's more expensive. You can say this is the standard price, but if you come earlier, I can give you a discount. Everyone likes a discount. No one likes more expensive, but the numbers can be the same.
Yeah, that's a good point. And as you can tell, I'm in finance, not sales, because any salesman would frame it up the way that you did and not the way that I did, and would be much more successful. So yeah, very good point, and thank you for pointing it out.
We all have our strengths.
Yes, absolutely. So yeah, so that's kind of how it goes. If there are any other examples that anyone wants to discuss, feel free. We'll back and forth for a little bit. Otherwise, every business is obviously so unique that I can't give a lot of generals in this environment or in this situation. I can't come up with a lot of things that apply universally to all or nearly all businesses out there. All right, so then, all right, so then I just wanted to touch on one area of budgeting that often gets neglected. Like, I have a lot of clients that focus on the amount they're going to bring in and the amount that they're going to have to pay. And they think, okay, I've got profit. I'm going to make profit. It's good. It's good. Let's go. Let's do it. But the balance sheet and cash flows are also a very important area to focus on. Balance sheet and cash flows, mainly it's about cash. The number one reason that businesses don't succeed isn't because it's a bad business idea, or because it's managed poorly, or because the world doesn't need it, or anything like that. The majority of businesses that don't succeed simply run out of cash. They just, they've got good ideas, they just can't fund them. So here, I don't want to get too deep into this projection, but I will go over some of the high notes. So again, this was a 3-year projected income statement for a audiovisual distribution company that a former colleague of mine wanted to start in Budapest. And she had some ideas. She had a few customers in mind that she'd already been talking to, knew that there was some interest, and had a rough idea of what we were going to be selling. And that's something that's always very important to me when I do my modeling, is I always try and talk in terms of the other party's language. If she's a salesman, so I really wanted to talk sales first and then build the rest off from there. If I'm talking with a finance person, I'll maybe focus on profit first and work my way back from profit. Talking with a salesman, sales first, talk about everything in terms of sales. We need to sell this much to break even. We need to sell at this price to this customer. But that's more for when working cross-functionally. So I don't think we need to get too deep into it just now. But yeah, we had a sales plan here, a few different customers. I've kind of blanked out their names just I have obviously permission to use this, but I don't want to throw any of her partners into the mix just yet. So yeah, we had a sales plan, and that sales plan, we had an idea of what we would be able to purchase these products for. This was not manufacturing, this was just buying and reselling. So we had some ideas of the kind of things that we would have to grant in terms of terms, conditions, promotion funds, discounts, etc. And her goal was, not necessarily to make money in year one, but by the end of year 3 to be turning a decent profit. So we put together a framework where we would lose a little bit of money in year 1 to get things going. By year 2, we would be break even. Year 3, making profit. Over 3 years, not a whole lot, $10,000 in profit when expressed in USD. She wanted to keep this in USD, even though most of the expenses would be in foreigns. Again, most of the revenue here was going to be USD or Euro. So yeah, not a whole lot of profit, but accomplished the goal of being profitable in 3 years. She had a couple $100,000 in financing lined up. So she thought that was pretty good. She thought that would, that would work. But what, again, what a lot of entrepreneurs don't consider is that in order to get those profits, you have to first, pay for the inventory, or pay for your contractors, or pay for your space, or pay for a lot of your expenses several months in advance of when you actually get to collect money. So that's what happened, or what could have happened here, and what would have happened if we had gone with the initial plan. We made some changes, obviously, since this didn't really work. But we were able to dive in, look at how much cash was going to be used to buy inventories, we looked at kind of what we would have to keep on hand to keep those few customers happy, even though there weren't very many in the early stages. Look at some prepayments to open up the warehouse and be able to get that to get those employees in and be able to service the business, et cetera, lots of different things. So yeah, we did some very basic. This isn't really fancy stuff here, but we did some basic cash flow modeling, using some relatively simple assumptions, in that it would take. Actually, this one was a bit more complex, because we predicted the payment terms that we would have to give to each of these potential customers, depending on whether they were dealers, retailers, or other distributors. She knows the business, and so she knows that distributors, you tend to have to give a little bit more generous terms, tighter. So yeah, we did some of that estimating what that net would all work out to. And so we predicted how long it would take to go from sales to collecting cash. We also predicted how long it would take from the moment that we bought inventory to the moment that we could sell that inventory. So those are kind of the purchase to pay cycle. And then offsetting that, when we buy inventory in this business, we don't have to pay for it right away. We get a few days to pay. And she was kind of like, yeah, we typically get 30 days to pay. I can push that to 45. I can just not pay for a few extra days and things will be okay. So yeah, that's kind of offsetting that long period of time between when you have to buy inventory and when you actually get the money for selling it. But those are the 3 big elements to cash flow planning. We did some of those rough estimates just to see, when we would have to be buying inventory versus when we were getting cash in, et cetera. And so we did a balance sheet and cash flow model based on those assumptions. again, starting with the, well, $200,000 of opening capital. And we looked and looked and looked and found out that we were burning cash, using it, investing more and more. And in month 11, we went negative. In year 2, we went even more negative. In year 3, we went even more negative. So, she was thinking that in her head that everything was going to be okay because she was making so much, she was making a certain percentage of profit via markup on each of these resales, and that if she was able to get sales up to a little under 2 million by year 3, that she would make enough to offset all of her expenses. That was true, but she wasn't thinking about the amount that she would have to have invested in inventory and the time it would take to actually collect that cash. And so she just wasn't thinking about that, and as a result, she was thinking in her head of a plan that just wasn't going to work. She was going to run out of cash. So she either needed to get more cash or needed to rethink some of the assumptions, trim down the expenses a little bit, maybe be more aggressive with the sales plan, maybe just wait a little, line up a couple more customers that can kind of pre-agree to be customers and develop a relationship before actually launching this thing. As it turned out, and I mentioned levers, and yes, we definitely had some levers in this model as well. The big one here was she going to hire help, yes or no? Since we put it all together and things didn't work out so well, we had to take that out, make things look a little bit better. That still didn't solve everything, but it got us close. And then again, we were able to take this, make some other iterations, make some other changes, sharpen our pencils, and resolve that disconnect. But yeah, just wanted to stress the importance of thinking about not just income and expenses, but also what's your cash look like, what does your balance sheet look like, and are you going to be able to keep the lights on, even if things go well. It's, as I mentioned, it's very easy to fall into a trap of thinking I'm making profit, my income exceeds my expenses, therefore everything is good. Meanwhile, cash is bleeding, and oops, business is dead because there's no more cash, can't pay people, can't keep the lights on, can't do anything. It's dead before you get to that point where you really start to take off and see the return on the investment. So yeah, bottom line, pay attention to the cash flows, pay attention to the balance sheet when building a budget. And yeah, doing something monthly like this is a great exercise just to see where's the bottom. Make sure that the bottom is well above 0 and that there's a little cushion. This would make me extremely uncomfortable because $6,000 is nothing. There's no way that we're going to be able to operate that well to be able to make it if we're planning to be within $6,000 of being bankrupt, there's no way we're going to survive. So this was not the final version. I just wanted to show it as an example of what can go wrong when you don't pay attention to the assets and liabilities and you're only looking at income and expenses. Any questions before we move on to working capital allocation? Okay. So the next part's a bit more fun. We talked about levers and kind of the answers to when things don't go well. Working capital allocation is the flip side of that discussion. When you do have success, when you do have some extra cash, or when you do have some opportunities in front of you, how do you make the most of them? Obviously, that's how the business can really grow and be successful. Having levers helps the business survive. Understanding working capital allocation and making the most of it is what helps the business grow and thrive. So I'm going to, again, spend most of this time in examples, just running through some of the things that I'm thinking of when I've done models in the past. So we'll get right down to it. I've just modeled out a few opportunities here. These, again, are going back to my days with Jack Links, where we were producing product. These are all going to focus on those bags of beef jerky and just look at some real decisions that we had to make as we were trying to grow that business, optimize profit, basically just take that business to the next level. So one thing that we often did is we were very heavy in retail. Not a lot of people buy snack foods over the internet. So most snack foods are still, they're purchased because you see them on the shelf and you want them and you go. So this was an opportunity to reach more points of sale. The idea here is, the idea here is to get the product off the shelf and onto the floor by way of a cardboard stand that kind of gets it almost at eye level and is right there in the aisle. So you have to walk around it and acknowledge it. And by being that annoying, a lot of people apparently like that and buy the product more often. I think it's really annoying, but it's a very effective sales technique. So we did a lot of it. So this was a classic example. I'm not going to get deep into the costing because that's a cost accounting exercise, and I would love to spend hours and hours talking about cost accounting with anyone that is doing manufacturing or distribution or otherwise is really concerned about understanding their product costs or just their cost in general. I'm not going to get too deep into it today. Suffice to say, there's a lot of analyzing of meat usage and costs and yields and seasonings and labor and machine time and factory overheads and things like that. What I will do is I do want to spend a little bit of time focusing on this distinction, the distinction of variable costs and fixed costs. Because this can apply to any business. Meat costs and labor and machine time only applies to businesses that deal in meat and machines and human labor. But the concept of a variable and a fixed cost applies to every business in the world. So this is the variable costs are the cost of selling, in this case, one more bag of beef jerky. So what are the variable costs of selling a bag of beef jerky? Well, we need to buy materials. We need to, we don't raise our own meat or we didn't raise our own meat at Jack Links. We bought it all. So if we sell more beef jerky, we need to buy more beef. We need to buy more salt and sugar and spices. We need to buy more bags. We need to buy more zippers. We need to buy more cardboard to ship the bags. All of that is one-to-one. So, sell one more bag of beef jerky, we need one more bag's worth of meat, guaranteed. Then there are things that are the fixed costs. The fixed costs are things like the heat or the cooling of the factory. If we sell one more bag of beef jerky, we're not going to expand the factory to sell one more bag. So the cost to heat and cool that plant are going to remain the same. We're not going to hire another plant manager. We're not going to go out and pay the USDA to certify a second facility, for example. So those were fixed costs in our analysis. The caveat here is that there is a time limit on fixed and variable. We tended to think in terms of about 3 to 6 months, as in if we were to sell 10% more product, what costs would we need to change over the next 3 to 6 months to do that. We would probably not hire another plant manager. We would probably not go out and buy new equipment. We would have to hire additional people to run that equipment. We would have to pay them overtime. We would have to, we would have to clean more often. So more cleaning supplies would be needed. So that's kind of how we were thinking fixed and variable costs. Things that might apply more to your businesses. So Candy, your rent is not going to change because there's one more person in the co-working space. It's probably not going to change if there's 20 more people in the co-working space. If there are 20 more people staying and working in the space, then you are probably going to have more maintenance costs, more cleaning, more toiletries, more of those kinds of things. I'm probably not doing a very good job because I don't know your business all that well. Coffee consumption, yeah, those are going to be your variable costs.
Yeah.
Yeah. So
fixed costs would be things like your hosting fees, your website hosting fees, and
yes,
things like that a lot of virtual businesses would have that.
Right. Yeah.
Wouldn't change regardless of how many people you have or how many customers.
Yeah. And then variable costs might be like if you're an e-commerce business, it might be your Amazon fees. Those are gonna, the Amazon advertising fees are per click, per sale, per whatever. Yeah, so those are going to ramp up.
Do you guys have some examples of what fixed or variable costs would be for businesses? I would assume like for Ruth in doing tax business, like the accounting software that you may or may not use, that's a fixed cost, right?
Yeah. I do a lot of tax work myself, and yes, it's a fixed cost, and so.
Yeah, for example, a couple of fixed costs would be, of course, the tax software that we're using, the client management system that we're using, although it depends on the number of seats. The more employees, the cost goes up. Variable cost would be our advertising, our marketing budget, for example, or how much we would have contractors for special projects, that kind of. But overall, it's not too much other than people cost and advertising, and not too much variable cost. And since most people are employees, those are fixed as well.
Yeah, a lot of service businesses do have those kinds of costs, a very heavy fixed cost structure. But there's also a cost of your time. You want to be paid for your time. So obviously you're not going to just cover your fixed costs. You're going to want to cover your fixed cost plus the time that you're putting into the business to serve the client yourself, I assume. So that's part of your pricing structure. It's you want to have something left over after the fixed costs are paid, and that's an implied variable cost.
Like another fixed cost you probably have to put in there, depending on the business, is insurance, whatever kind of liability insurance you need, or insurance against the major risk you identified, which some people might be willing to skip if it gets tight money-wise, although that might not be a wise decision.
Yeah. Yeah. So, but yeah, what I'm trying to get at, and I know we're kind of eating time here, is that every business has a fixed and variable cost structure. And so we spent a lot of time looking at these kinds of P&Ls where we would understand the selling price, we would understand the discounts, the net invoice, the different promotions, reclaim, all these different customer programs. We don't need to get into all of them. These were just basically other forms of discounts. So the net is for this type of product, for this type of customer, we would expect to actually be paid $3.03 for every bag of jerky. And then depending on what type of product or what form the product took, we would expect to see variable costs of either $1.60 for our current product or $1.87 for our proposed product. And so we would see incremental profit. So for every extra bag of product that we sold, we're currently netting $1.26 for every extra bag. And with the new changes, with the extra packaging, the extra labor, etc., for the proposal, we were netting only 98 cents. So obviously that's 98 cents is less than $1.26. Why would we ever do something like that? Why would we take less profit? Well, because we're going to sell more bags. You know, we put that shipper right there in front of people, they take it. Studies show that it's like 75 to 80% of the sales that you get off of that shipper are sales to people that would not take the same product off the shelf if it's sitting on the shelf 5 feet away or 5 meters away. It's that powerful. So we do that to bring awareness and to sell more product. So in this case, even though we're getting less per bag because of the extra packaging and the extra promotion and the extra everything, we still wind up making more money overall. So is that a good decision? Is that good? Is $147,000 better than $126,000? Well, yes, that's pretty obvious. If when all is said and done, you'd rather have 147,000 than 126,000. What does it take to actually get that? What does it take to get that extra money? In this case, we do have to make some investments. We have to make some upfront investments. So these are kind of like they're fixed costs, but they're fixed costs that we only have if we take on this project. If we decide to develop a new stand, we have to pay a little bit of money to our suppliers to get the die line set so they can produce the stand itself. We have to pay a little bit to the printer to get the right graphics on that product. So these would be considered as fixed costs, but they're costs that we only have with this project. So they're variable to the project, if that makes any sense. So the upshot is that we know we have to invest about $10,000 to get this project off the ground. And then on top of that, we are selling more product. That means that we are going to have to go out and buy more meat. We're going to have to buy more seasoning, pay more people, and we're going to have to do all of that before we can sell the product. Meaning that we're going to have to put some of our money in. We're going to have to make that investment. And it's going to be, under this cost structure, about $20,000 worth of additional working capital. So we're going to have to fork over $10,000 of money that we're not getting back to these suppliers of the packaging materials. And we're also going to have to kind of temporarily invest about $20,000 in materials, labor, et cetera, to get the project off the ground, to build the inventory that we can sell to meet the customer's needs. So all told, we're investing about $30,000 worth of our working capital before the project even gets going in year 0. And then if we assume this thing, we assume that we've done a good job of estimating the receptiveness, and we assume that we've done our diligence there, and we have a good idea of how much more product we'll sell. We're going to make about $21,000 more per year going forward. So at the end of the day, or at the end of 3 years, if this model is perfect, again, no model ever is, but if this model turned out to be perfect, we would wind up profiting about $33,000, or wind up profiting about $63,000 on our investment of $30,000. Yeah. Okay. So through the concept of an NPV, that's just an Excel function. You can Google that or not Google, but you can do the help in Excel to figure out how much that, how to use that function. But through the magic of NPV, we can see that the net present value of these particular investments and wins is about $21,000. And then the IRR is 49%, which means that it's the equivalent of like making 49% per year on that investment. So that's one project. And notice that I'm looking at I'm always looking at two things. Like there's always two options, at least two options on the table. There's always actually more than two options on the table. But I would never want to look at just this. Like I would never just want to look at the current proposal. I always need to compare it to something. So this is what happens. This is what we think happens if we go ahead and we take this project on. This is what we think happens if we don't take the project on. You know, there's always a base case. There's always this is what happens if we do nothing. There's always a baseline in play. So just wanted to point that out and stress the importance of, you know, you're trying to make a decision, and so you want to model out both sides of the decision. If there's no decision to be made, then why model it? You just do the one option. If you only have one choice, go do it. You got no choice. So modeling is kind of pointless if you don't have a choice. But if you have a decision, then clearly you have options, at least two of them, and you definitely want to have both options in front of you to make the best, most informed decision. Okay, so had a couple others here. This was a new product placement. This is a new customer, so we're going after a customer we don't currently have. Not a huge customer, we think they can maybe do about 16,000 bags of product per year. In this case, our base is nothing. If we don't get this customer, we don't sell that product. You could argue that maybe our consumers would go to a different retailer and get it, and I doubt it. Not too much of that would happen. So in this case, we don't really have to do much to our cost structure, but we do have to give this new customer a little bit better deal. They want more margin, so they're demanding a slightly lower price, more support in terms of promotion dollars. So we get more sales and we get more profits, but it's less profit per bag again. So again, that's a very common decision. Do you want more business that's less profitable, or do you want to have less business that's more profitable? That's a very common decision that businesses have to make and decide what they want to go after. And then this is another similar situation. This is about developing a new flavor. Again, new flavor, probably going to attract a few more people. More folks are going to want to try it. They're going to just buy more bags, more likely. Not that much more. Studies showed that about 20% of the new flavor sales are actual gains, and the other 80% are just people buying the new flavor instead of a flavor they were going to buy anyways. So it's not too incremental. But this was a complex flavor. It had like chili flake and lime seasoning and extra labor involved and blah, blah, blah. So again, there was going to be less profit per bag, but more bags. Is it a good thing? So you do see that we have positive NPVs on all of these. Anyone want to take a guess which of these projects are good projects and which of these projects are bad projects? Anyone? Random guess. You got a 30% chance.
Can you repeat the question? Sorry, I had to step away for just a second.
I'm just looking at 3 different projects. You know, we've got positive NPV on all of them. They have pretty different IRRs. But anybody want to take a guess? You know, they're all profitable in the end. Anyone want to take a guess which of these are good? Are they all good? Are they all bad? Are some good, some not good?
The one that had 222%, that
Mhm.
one, is that a good
Mhm.
one?
It's a good guess. It's a good guess. Real answer is that's a trick question. At this point, I have no idea which of these are good and which of these are bad, because good and bad is relative. What I always want to do as a business owner, and what I always really tried to drive home as finance manager, was that you don't want to be thinking, you know, is this good or is this bad? You want to be thinking, is this the best project that I could undertake right now with the capital I have available? So in order to make those kinds of decisions, I'm keeping, again, this is like the opposite of the levers list. This is kind of the working capital ideas list. When I have some extra cash, when I have, you know, a little bit left over in my business plan, what do I want to do with it? I could invest $6,000 and go after that new customer. I could invest $30,000 and roll out a floor shipper. And get that extra placement, get really in your face with existing customers. I could invest $60,000 and develop a new flavor. I could invest $100,000 and I could put that into the operations and try and reduce my cost per bag on all of my product by controlling better how much goes into that bag and making sure we're getting that weight just right. I could invest maybe $250,000 and finally solve this crazy stick problem that we were having, where the product, like creatine, was coming out of the product and it looked like mold. It wasn't mold, it was perfectly safe, but it looked like mold, so no one would buy that product. And so we were having to destroy about 5% of our stick product because it looked like mold and no retailer would sell it. So, you know, those were the kind of decisions that we were making on a weekly basis. And having a list like this, our actual list was like 50 or 60 projects long. But having a list like that was a great way for us to sit down and evaluate what we want to do with our available capital this week, next year. You know, how do we want to take the business from where it is today to where we want it to be in the future, and which projects are going to help us get there the most with the least amount of capital invested. So if we had a lot of capital available, you know, we were having a really good year, meat prices were low, sales were up, we might take on more projects like this one. If we were having a really tough year, meat prices were high, people weren't driving as much, people weren't buying as much beef jerky, we might, you know, look at more opportunities like this one. So it's all relative, you know, it's all, is this the best that I can do with my money right now, or over the next few months, next year, whatever your time frame is this really the best thing that I could be doing? Or is there something out there that's better, that's on the table for my business right now? It's not so much, is this a good investment? Because they're all good, like, except for this one, we really had to work to make this one work. But the others are all good. Like, they're all positive NPVs, they're all positive IRRs. These are all really strong returns in an investing world. And most of the projects we looked at, they were good. Like, if there were no other opportunities on the table, you'd say, yeah, we'll do that. But it's about, you know, it's about ranking your opportunities, keeping an eye on them, and figuring out what's the best one, you know, what's the best opportunity I can invest in with the money that I have available now. So
This looks like a super helpful graph here when you break down, because I think anybody in business has projects they dream about, you know, instituting or whatever. And to break it down like this, for me anyway, just looking at this, it's like, oh, okay, if I've got, where's the investment line?
I think I scrolled a little too far.
Yeah, okay, right there. Yeah. So it's, for me, it would be a question of, okay, I've got 30,000 that I can reinvest right now, but do I want to invest that 30,000 or do I want to wait however long and get the 60,000 to reinvest? So for me, looking at it that way would be a super helpful decision-making.
Yeah, yeah, it's helpful to me too, and you know, in my personal life as well. I keep lists like this in front of me so that I just don't forget about things, because otherwise it's very easy to, you know, have that idea to think, oh, I should whatever, I should invest in crypto, but now's not the right time. And then, you know, a year later, it's like, oh man, you know,
I
the
would
right
have done
time
it.
was 6
I
months
think
ago, but I
that's
forgot.
a super important topic that you bring up about timing of some investment. I mean, if you're just starting out with a new business, for example, you have all the things, you want to have this new fancy website and rank high for your articles, and you might have the project of putting a lot of work, hiring someone to do all your content and SEO, or put some money into, I don't know, Facebook ads or other advertising. One has a pretty quick payoff, the other one takes a little bit longer to build. Both might have the same kind of return. One probably has a much better longer term return, because Facebook ads, as soon as you stop paying for them, the exposure disappears, versus SEO starts building and building. But those might be also some interesting options for new business owners to compare when they look at their marketing.
Yes. Yeah, and that
Timing sometimes
time,
is everything, as you said with crypto.
yeah. And that time, you know, that time to pay off will show up in the NPV, because net present value is a time-based calculation. It's, you know, it's the net present value today. So if something takes 5 years to pay off, the net present value will be much lower than something that's going to pay off next week.
Brett, are there templates or something that would help the layman to do this sort of like higher level, not this quite this in depth maybe, but to kind of put together on our own something?
I mean, I honestly would recommend that you just build your own. This, you know, this form was something that we built at Jack Links because it was directly tailored to the things that Jack Links deals with. You know, we dealt with promotions on almost every customer in almost every sales channel. We had a sell-through guarantee, so reclaim was always a part of the decision making. Terms, discounts, always, you know, almost always there, blah blah blah.
So for those of us that maybe aren't so great at putting spreadsheets together and don't necessarily like numbers, is that something that you, as your business, do you work with startups and small companies?
Yeah, absolutely. Yeah, so I can build things like this and tailor it to your business. Yeah. It's just spreadsheet work, so, you know, if you have even a basic understanding of Excel, feel free to give it a shot and see how it works. It's
Actually, there are also some Excel templates out there that you can use as a starting point. Just free templates that are part of the Excel package or Google.
Yeah, I just highly recommend you customize them, because, yeah, I mean.
Right.
Yeah,
if you don't know really what you're doing, then it's kind of hard to do.
I downloaded some templates a while back, like 3 years ago when I was considering doing this business. And because they were developed by people like you that understand numbers and all of the calculations and whatnot, it was a very complicated spreadsheet to actually, for a lay person like myself, to actually utilize. So yeah.
Yeah, but then you just wind up with lots of lines that aren't used, and just aesthetically, it makes me feel like the spreadsheet can't have a lot of value if you're using,
Can't use
you know,
it.
20% of it. It's difficult to digest that way.
Yeah.
You know, maybe that's not such a big concern if you're just doing it for yourself and you're not presenting. I was always presenting these to, you know, an executive committee or a marketing team or somebody that was making the final go, no go decision. So, you know, one of my great rules in business and in report generating is that pretty matters. You know, it needs to be, you know, it doesn't need to be super sexy and, you know, full of graphics and effects and everything, but it needs to be clean and simple and at least well laid out and easy to digest, and that makes it much more valuable, because then people can digest the information and can actually use it to make a decision, and that's what we're all about. It's not about getting to the right number, it's about getting to the right decision.
Right. So we're actually running out of time. Was there anything that you had left in the presentation that you really wanted to touch on before we finish up?
You know, if we had time, I would go over some accounting. Oh, I did want to just highlight this particular project. I chose this one for a reason. I didn't do the detail, or I didn't include the detailed calculations, but I did include it as a project that didn't look so good. We ran the numbers. It just wasn't that attractive. It was cheaper just to keep destroying product in the field than it was to actually fix it at the moment. And so that was one where we did the analysis, and the decision was, no, we don't do that right now, or we need to figure out a way to reformulate and take costs out to make this worthwhile. So sometimes the analysis suggests it's a no. You know, the goal is to make the best decision. That decision doesn't necessarily have to be we're going forward. You know, sometimes if the answer is we're not doing this project, then that's just as successful from a financial perspective as we are doing this project. It's just about making the right decision for the business.
Samir just posted a big, long question. I'm going to let you read it.
Okay. Okay, so this is a bit off topic. However, would you recommend implementing an efficient structure for tax planning from the startup phase of a business, or once a business is established and start making decent profits? Also, do you have any recommendations around tax jurisdiction on where to set up your company if you are a solopreneur? With Georgia specifically, I've heard some mixed responses. Virtual zone. Well, I'll touch on it briefly. I don't know a lot about Georgia specifically. I do know that it is not on anyone's list of tax havens. So, you know, nobody is saying I need to be in Georgia because the taxes are so good there. You know, that's the best place for an entrepreneur. No one is saying that. They are saying places like Estonia, Malta, Paraguay, like Dubai, Hong Kong, Bahamas. There's actually a lot of places in the Caribbean.
I think Ruth has done some investigation into the tax issues here in Georgia, haven't you?
We looked to it a little bit, but overall, your best jurisdiction for a business depends on a couple of different factors. One of them is your citizenship. If you're a US citizen, then it's completely different than if you're from another country that has a different tax system. So if you're a US citizen, you always have to file your US tax returns and you optimize in a different way than, let's say you're a German, you're nomading, you're outside of Germany, you don't have any tax obligations to Germany after a while anymore. So that's one of the important things to take into account. The other one are a couple of other things on what you're really looking for. For example, Hong Kong is pretty good. It's a very established, good jurisdiction, but it's expensive. You have yearly accounting requirements that are expensive. For that, Georgia, for example, is way cheaper. And you're right, it's not on any kind of tax haven blacklist, so it doesn't have the negative connotation that some other countries have, where, yeah, you might be able to do your business, set up your business and get a bank account, but everyone looks at it as a shady jurisdiction, which may not be helpful if you need your business to be looking very legit and having challenges with that. So good jurisdiction depends on many factors. Actually, that's something that our sister company does, Global Expert Advisors, looking at jurisdictions. And we have a blog post out there on things to look for when deciding on what is a good jurisdiction. I can pull that up and send that to Candy if you want to share that.
Yeah, and Ruth, maybe and Samir too. Maybe that's a great topic for a more in-depth discussion as well. If you've got some resources, Ruth, maybe we can chat after this and see what we might be able to come up with for doing a secondary discussion more geared towards that sort of part of it.
Just one little unexpected thing. For example, if you're not a U.S. taxpayer, then a U.S.-based LLC could be very beneficial, because depending on circumstances, you may not even have to pay any US tax, and depending on your other residency, citizenship, etc., you may end up not having to pay tax anywhere, or only in the country where you're living that may be a low tax jurisdiction. So it's really it's a difficult question. There's no cookie cutter answer, and sometimes options are surprising, like a US LLC for foreigners, for non-US people.
We're actually having a discussion on US LLCs coming up in May. We have an attorney that is going to join us and speak about that in specific. So keep an eye out. If that's something you guys are interested in, keep an eye out for that. Any final thoughts, Brett?
No, not particularly, but yeah, just if there's a couple of bullet points to take away, it's, don't forget about cash. Remember the balance sheet when budgeting. Keep that hit list, both the positives with those levers you can pull when things go south, and the negatives that you can pull when things go south, and the positives, what you can do when you have some cash available. And just always remember, it's not about right or wrong with financial analysis. It's about good, better, and best. And your goal is to make the best possible decision, the best investments. And so, yeah, just keep that in mind when doing the financial analysis, and don't try to never do financial analysis in a vacuum. And you'll find that it's much more valuable, and you'll be much more informed, and you'll be much more confident making your decisions.
Thank you. Can I have you stop your screen share? I should be able to do that, but there we go. I want to do a quick screenshot if we can here. Cancel. All right. Thanks, everybody, by the way, for showing up today. Can we get Russell, Samir, and JW on video? Chris? I'd love to take a photo. Awesome. Can we all give Brett a thumbs up? Yep. Thank you, Brett. I really appreciate it.
Thank you.
Yeah, and again, I will post the information on how to reach out to Brett if you guys have additional questions. So, yeah, I would extend this conversation because I feel like there's a ton more we could talk about, but I've got another commitment coming up, so I've got to personally run. But thanks again, guys. Really appreciate it. Appreciate you all showing up. If you have ideas for other content or other topics that we could cover to help you out, or if you want to present or share a topic with us, let us know. Follow Lokal Tbilisi's Facebook for all of our upcoming events, and that's my wonderful spiel. So
Thanks for putting this together, Candy, and thank you, Brett, for presenting.
Yeah, thanks for attending, and I hope it's helpful.
thanks, guys.
Thank you.
Right, ciao.